Two people can retire with the same money, earn the same average return, and still end up in very different places. The difference may be one thing they cannot control: the order in which the good and bad market years arrive. This is called sequence of returns risk. It sounds technical, but the idea is simple. When you are taking money out of a portfolio, a bad market early in retirement can hurt more than the same bad market later. Most people hear about investing in terms of average returns. If a portfolio averages a decent return over many years, it sounds like everything should work out. But retirement is not just about the average. It is also about the path your money takes while you are spending it. Before retirement, you are usually adding money. You save from paychecks, invest regularly, and let the account grow. During this stage, a market decline can be painful, but it may also let future contributions buy investments at lower prices. Retirement flips the direction of the cash flow. Instead of adding money, you start withdrawing it. Now, a market decline creates a different problem. If you need cash during the downturn, you may have to sell investments when their prices are temporarily depressed. Imagine your portfolio is made of shares. If shares are worth a lot, you can sell a few to cover spending. If shares fall in value, the same grocery bill, mortgage payment, or travel budget requires selling more shares. Those sold shares are gone forever. When the market later recovers, only the shares you still own get to participate. If early withdrawals forced you to sell a large number of shares, your portfolio may not bounce back the way the market index does. The market can recover while your account remains weakened. Let us use a simple example. Two retirees each start with $1 million. Each withdraws $50,000 at the end of every year. Over 4 years, they both experience the same 4 returns, but in opposite orders. Retiree A gets the rough start. The portfolio falls 20% in year 1, then falls 10% in year 2. After that, it gains 10%, then 20%. The 4 returns are not terrible as a set, but the early damage happens while withdrawals are beginning. Retiree B gets the same returns in reverse. First comes a 20% gain, then a 10% gain. The losses arrive later. This retiree still faces the same bad years, but they happen after the portfolio has had time to grow. Using those simple numbers, retiree A ends with about $715,000 after 4 withdrawals. Retiree B ends with about $785,000. Same starting amount, same withdrawals, same returns. Different order, different result. If this kind of money math helps you understand retirement decisions more clearly, consider subscribing. The goal here is not to predict markets. It is to explain the moving parts so financial choices feel less mysterious and easier to discuss. Here is the key. Without withdrawals, the order of those returns would not change the final result. Multiplication works the same in any order. But once withdrawals enter the picture, the account balance changes after each year, and the timing starts to matter. A portfolio in retirement is like a water bucket with a spout. Investment returns can refill the bucket, but withdrawals drain it. If a drought happens right after you open the spout, the bucket can fall to a low level before the rain returns. The first several years of retirement are especially important because the portfolio may be near its largest size, and withdrawals may be just beginning. A large loss at that point affects a big dollar amounts, and the retiree has fewer working years to rebuild savings. A bear market late in retirement is still unpleasant. No one enjoys seeing an account fall. But if the plan has already survived many years of withdrawals, the same percentage decline may be less dangerous than it would have been at the beginning. Sequence risk is often discussed with stocks because stock prices can move sharply. But the broader issue is any investment that can lose value while you are selling from it. Bonds, funds, and mixed portfolios can all face some version of timing risk. Inflation can make the problem harder. If living costs rise, a retiree may need larger withdrawals just when the portfolio is down. That combination can force more selling at low prices, which leaves fewer assets to recover later. Sequence risk becomes more dangerous when withdrawals are high compared with the portfolio. A small withdrawal gives the account more room to recover. A large withdrawal can turn a temporary market decline into a permanent hole in the plan. A common misunderstanding is that a long-term average return is a promise. It is not. Average returns are summaries of the past or assumptions for planning. Real-life returns arrive unevenly, and retirement spending happens in real calendar years, not in averages. Many retirement projections use smooth growth to keep the math simple. That can be useful for learning, but it can also create false comfort. Real portfolios do not usually climb in a neat straight line. They rise, fall, pause, and surprise people. This is why retirement timing can feel unfair. Someone who retires into a strong market may look brilliant. Someone who retires into a severe downturn may struggle, even with similar savings habits. The difference may be market timing, not personal skill. That does not mean the solution is to perfectly time retirement around the market. Nobody can reliably know what the next several years of returns will be. A stronger approach is to build a plan that can survive more than one possible sequence. One defense is flexible spending. If markets fall early in retirement, a retiree might temporarily reduce optional expenses. That could mean delaying a large trip, choosing a smaller home project, or trimming discretionary spending until the portfolio has more breathing room. This works best when spending is separated into needs and wants. Housing, food, insurance, and basic bills are harder to cut. Travel, gifts, upgrades, and luxuries may be easier to pause. Flexibility gives the plan a shock absorber. Another defense is keeping a buffer of safer assets, such as cash or short-term high-quality bonds. The idea is not to avoid risk forever. The idea is to have a place to draw from during market stress, so stocks are not sold at the worst moment. A buffer has trade-offs. Holding too much in cash can reduce long-term growth, especially when prices rise over time. Holding too little can leave a retiree exposed during a downturn. The right balance depends on spending needs, risk tolerance, and other income sources. Diversification can also help. A portfolio spread across different asset types may not avoid losses, but it may reduce the chance that everything falls together by the same amount. Lower volatility can make withdrawals easier to manage during difficult periods. Reliable income sources can reduce pressure on the portfolio. Social Security, pensions, annuities, part-time work, or rental income may cover some basic expenses. When essential bills are partly covered, the investment account may not need to supply every dollar during a downturn. For some people, working a little longer can reduce sequence risk in 3 ways. It may allow more saving, delay withdrawals, and shorten the number of years the portfolio must support. Even part-time work can sometimes give a struggling plan more flexibility. Some retirees reduce portfolio risk as they approach retirement, then adjust later based on the plan. The purpose is not to eliminate growth assets. It is to avoid having the entire retirement dream depend on a very aggressive portfolio during the most fragile years. There is an important balance. Being too aggressive can make early losses dangerous. Being too conservative can make it hard to keep up with decades of spending and inflation. Retirement planning is often about balancing short-term stability with long-term purchasing power. You may hear simple withdrawal rules, such as taking a certain percentage in the first year and adjusting later. These rules can be useful starting points, but they are not magic guarantees. They depend on market returns, inflation, fees, taxes, lifespan, and behavior. A good retirement plan is usually not set once and ignored forever. It should be reviewed as markets change, expenses change, health changes, and income sources begin. Sequence risk is easier to manage when the plan allows course corrections. Sequence risk is not only math, it is emotional. A new retiree who sees a portfolio drop may feel fear, regret, or pressure to make drastic decisions. Having a plan before the downturn can help reduce panic when markets are loud. The lesson is not that retirement is impossible unless markets cooperate perfectly. The lesson is that withdrawals change the math. A bad sequence early on can do lasting damage, so retirement planning should prepare for timing risk before timing risk appears. Average returns still matter, but they are only part of the story. The order of returns, the size of withdrawals, the flexibility of spending, and the safety margin in the plan all work together. Retirement success is a path problem, not just a number problem. What part of retirement income planning feels most confusing to you? Is it withdrawal rates, Social Security timing, inflation, taxes, or something else? Leave a question in the comments or suggest the next money concept you want explained in plain English.